This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 194. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rcraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. We are just over 2 months away from the SNN Network Canada virtual event, our next virtual event on the schedule here, coming from SNN Network. That event is taking place December 7 through 9, 2021. Again, due to popular demand, Paul Andriola from Small Cap Discoveries and myself on behalf of SNN Network are teaming up to highlight our neighbors to the north, Canada. We already have an incredible list of companies that are signed up, which we will be sharing shortly. Be sure to register so that you can get all those announcements as they are announced. So to register for the event, please go to our website, canada.snn.network. Click the register button, and I look forward to seeing you all there. Now, for this episode of the Planet MicroCap Podcast, I spoke with Jon Cukierwar. He's the founder of Sohra Peak Capital Partners. I recently met Jon at one of our virtual events, and as a fellow millennial passionate about small microcap stocks, I had to invite him on. Jon recently launched Sohra Peak Capital this summer with an investment process that focuses on his own 21-point proprietary investment framework. His background and passion led to what sets him and Sohra Peak apart: finding inefficiencies in small caps, looking globally with a long-term time horizon. I really enjoy featuring new emerging fund managers on the pod, and based on Jon's background, passion, and clear focus, he's one to watch for sure. Thank you again for tuning in to episode 194 of the Planet MicroCap Podcast, and please enjoy my conversation with Jon Cukierwar. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today, my guest is, we just recently met, but I feel like we're already kind of mishpucha in a roundabout way. You know, it's just kind of like that.
100%.
It's just kind of like that. So joining me right now is Jon Cukierwar. He is the founder of Sohra Peak Capital. Jon, thank you so much for joining me today. And I'm sorry if I butchered your last name. I promise by the end it will be perfected. That's all I'll be thinking about. I won't even think about the question I'm going to ask you. I'm just going to be thinking about that.
No, you got it perfectly. And Bobby, I am thrilled to be on your podcast today. I'm a big fan and I've heard terrific interviews. I'm just very excited to be part of it. So thank you for having me here.
Dude, it's great to have you. And thank you for that. I really do appreciate that. So, we were just talking offline. I mean, give me a little, I'd love to know where your passion for investing began, and also, where your last name, where its origins from too. I mean, as you said, there's only been one person that's perfectly pronounced it prior to today. Well, you had to teach me, but I was close. I was like 98%.
Yeah, you were very close. Yeah, it's that C that trips people up.
So tell me, where did your passion for investing begin?
Yeah, sure thing, Bobby. So I'll give a little bit of background about, my parents and how I, got to learn about investing. So, kind of starts back. I grew up in Westchester, New York, and, my parents, my dad, he grew up in Brooklyn, and his parents actually, kind of going back to, the last name and its origins, his parents are from Poland. And, it's a very unique story, personal to me. Obviously, it's a big part of my heritage. So, they were Jewish, and they, they'd gone through a lot. They are survivors of the Holocaust. And, my dad, his parents, somehow, they have their own stories that are just extraordinary, and they managed to make their way. They had, their parents, their siblings all perished. And, and I actually visited Poland for the first time a couple of years ago with my family, and it was a very, insightful trip. And, so anyway, my grandparents immigrated here, and, they grew up in Brooklyn. My dad grew up with four of his siblings, and he was the first of his siblings to graduate from college, and the first of anyone in his family to graduate from college. He went to a city college, and he's a jeweler. He opened up he operated a store in Brooklyn for many years, and so he really kind of had a tough deal in life, and to kind of get to where he is, and make it out of Brighton Beach. And my mother too. She is, and this is where my fund is named. She is from a place in Northeast India that nobody's ever heard of. You need to fly to an airport and go to another airport, and then you need to take like a trip on a bus up into the mountains. And maybe now 1 million people, maybe a bit more, live there, but for most of her life it was in like the tens, maybe a couple 100,000 tops. It was a very small community there, and nobody ever kind of makes it out of there. And her mom, when she was 18 years old, she came over here to New York as well. And she did 1 year of high school. They moved to the Bronx. They really had kind of nothing to their name. And, she always had this dream of being a doctor, and she was committed to it. So she went to a city college here too. And, she persevered through thick and thin with little more than hope, and having her mom there, and they both made it. So, I just mentioned all this because I really think it kind of has influenced me and made me who I am in many big ways. They gave me a ton of opportunity growing up in Westchester, New York, where, excellent school systems. And, we were, they definitely, they bought a house at a great time in the 90s, and, before real estate prices really rocketed up, but it also kind of, it gave me almost a value investor mindset as a person, always kind of being able to, being okay with not having like too many frills, and kind of having a lean family operating structure. And, and right now, like my business is a very like lean operating structure, right? Starting out small and kind of surviving, but I've always kind of, loved and thrived on that as well. So that's kind of shaped me in a big way. And by the way, where my mom is from, there's a very beautiful forested mountain range called Sora. It's a small town over there, and it also holds the record for the most rainfall in anywhere in the earth. And so you go there, and it's like always raining. And I tell people, and I tell people, but for me, that means it's going to be raining great ideas, of course, with the partnership. And so
there you go. Count it.
Yeah. So anyway, fast forward to kind of high school. I always wanted to take after my mom and become a doctor. And, then I took AP economics in senior year of high school, and, our teacher was totally awesome, Mr. Brown, and, still stay in touch with him. He's a great guy. And it was the first time like I took a class, and I thought, wow, like this, I feel, this is really awesome stuff. And I really wish to learn more about this beyond the scope of this class. And so, kind of when I was putting my majors down, and when I got to school, I put down, either economics, or if they had a business school, finance. And so, kind of my choices were between, almost went to USC, almost went to Michigan, but I ended up going to Tulane in New Orleans. There's a lot of wonderful things about the city. Most importantly, though, they did give me a very big scholarship, and that was very important to my parents. And so, ended up going there. And I always kind of thought, like, no matter where I go, as long as I bet on myself and I do well, I'm going to find a way, and, I'm going to be okay. Right. And so I was majoring in finance, and taking classes, getting good grades, and, but everyone's talking about investment banking and sales and trading, and, pursuing these avenues. And I never really, found a calling like, oh, well, I totally want to do this or that. So maybe the luckiest thing that ever happened to me was the summer after my sophomore year. I was 19 years old, and I met somebody, out of respect for privacy for him. I won't mention his name, but he's a professor at an MBA program And he gave me a list of books, and he said, hey, like, here is the syllabus that I give to my students, and for his executive MBA students, and like, here are the books that I recommend, like I require them to read. And so he said, hey, well, if you're interested, you majoring in finance, like maybe read these books, see if you like them. So the first one was The Intelligent Investor, the second one was The Essays of Warren Buffett, and then Common Stocks and Uncommon Profits. And there was like 4 or 5 more. I ended up reading those first 3 kind of over the next few months, and I, for the first time, I had that aha moment that I guess every investor with one of these stories has, like, well, it makes all the sense in the world to me. If I can buy something, right, at significantly below its perceived intrinsic value, whether, hunting where others aren't, which is kind of where I got influenced early to begin with, when, in the theme of microcaps, or, just really having a varying perception, then this makes all the sense in the world. And this is something, I want to pursue. It seems, very, very challenging. It seems intellectually stimulating. So that's kind of where it began. Then there was one more really cool thing. My junior year as well, kind of right after that, almost like in lockstep, I took a class. It's more of a program called Burke and Road Reports at Tulane. And the whole class, it's not like structured with lectures. It's you get on a team and you're like equity research analysts for a company, right? You have to write like a full report. And, they really, he required me to read the Peter Lynch book, Went Up on Wall Street. That was very influential. He had us go like fly out to company headquarters. Every student had to. So we flew out to Atlanta, Georgia, where the Popeyes headquarters was. Our company was Popeyes, the fast food chain. And so, meeting with like CEO and the president and the CFO, and this is cool. This is awesome. And we're kind of asking questions and gaining insight. And, we look back and kind of check up on some of the other, research out there. And we're thinking, obviously we're not very skilled at the time, just starting up, but, yeah, maybe it seems that some of these data points we learn aren't really reflected, kind of in the consensus thesis. And, maybe this actually could be a good investment opportunity. And so we wrote a whole report on it, and so that was very influential as well. So that's kind of where it all started, right? 19 years old. And, I thought long term, there's going to be steps to get there, but, kind of working, with the end game in mind, right? My goal was, look, these people inspire me. I really want to be an investor. And one day I want to run, my own fund, my own partnership. And, and the way to get there is you have to become a really good investor first, or become a good enough investor. And to do that, you need to learn from really good investors. And then to learn from really good investors, like, you need to go work for them. Right. And then, like, to go work for them, maybe you have to get a job there. So I was kind of, like, already kind of pacing all these things out. This is like almost 10 years ago, but, Tulane was really wonderful. And, there was another class senior year where, you get to manage a portion of the school's endowment called Darwin Fenner. And, you have to apply to the class. And that was a really terrific class. And we read all the research papers of, like the classic research papers in academia, right? Like, the LSV paper where they kind of discovered for the first time, documented that, price to book was a statistically significant indicator that, that stocks are cheap. The first papers that indicated that momentum strategy works. The first paper that indicated that, this strategy works and that strategy works. And we had to read through all of these. And, that kind of taught me to also screen as well, in a very bare bones basis, like with Excel and data. We had to do that for that class. Other cool classes, we had, cases in entrepreneurship by Professor Pulitzer. And, he somehow pulled in all these CEOs. Like, I'm sitting there, he pulled in the CEO of Pool Corp to like speak to the class. But now it's like a $20 billion company, but it was a microcap once. And it was, it was a really small company once. And like, this is awesome, and all the students left and right, I think, a lot of them are, it's like a Wednesday night kind of, tuning out, but I'm like, this is cool stuff. Anyway, so, from there, kind of the next step was like getting a job, right? And, wanting to get the most competitive job to bolster your resume, and then have the opportunity to take the next step to maybe go to the buy side for a good manager. So, and from coming from Tulane, also another good skill that it really helped me was, unfortunately, not like, other schools, Goldman Sachs and JP Morgan, et cetera, they're not banging down your door to go hire you, right? That's, Harvard and that's Princeton, unbelievably smart. I have so many friends that went to these schools and they're unbelievably smart. And, so for us, it was more, you can definitely be good enough, but you have to, you have to pave your way. You have to bang down their doors. You have to learn how to really network and get out there. So that kind of forced me. I used to be like quite introverted and definitely like, not as comfortable talking to people. But, I was kind of forced, like, over the summers and my spring breaks and, like, phone calls and emails, like just really learning how to navigate LinkedIn, like, masterfully and reaching out to people. So eventually, I landed an interview with Citigroup in New York and got an interview, and I got the job and I interned there. And then after that, I got the full-time job. And so I was working, in banking for Citigroup. I was in their internal M&A group over there, which they handle the mergers and acquisitions for Citigroup on a proprietary basis. And they're where they want to acquire or dispose of financial segments and other operating segments of the business. So it was great exposure. I mean, look, it's classic, like, very, very long hours, but terrific exposure. Deals, we had some cool deals like in South America. I went to Brazil a couple of times during my time there, and learning, working in Excel and PowerPoint and meeting all the deadlines, and all that. But investing had always, captured my attention. Like I never forgot about it. And I'm always just kind of thinking, okay, this is great, but, maybe it's not the best attitude to have. Like it doesn't make you the best analyst for that group. But, I'm thinking ahead and I want to get to, that next step, right? So how do I do that? And, in the meantime, I'm doing everything I can. I pursued the CFA and, I passed level 1 that year. And then, the next couple in the years after. And then, I was writing articles in Seeking Alpha at the time. I actually had a really cool moment there. I found a microcap company, K12. Have you heard of them?
Oh, which one again? Who?
K12.
K12.
Yeah, the ticker is LRN.
LRN. It's sounding kind of familiar, but yeah, no, continue.
Okay. No, anyway, so yeah, I found them and I thought they were particularly interesting. It was like the third write-up I did. And it was one of these really cool moments when you're kind of really starting out. And I published a long pitch on Seeking Alpha. And so like, I think 1 or 2 couple months later, I received a notification on my phone and I think the headline was like K12, source after record earnings, here's who called it. And I clicked the link and it's like, and then like the last bullet was like essay contributor, Jon Cukierwar, was the only person on Wall Street with this call. And, it was like, 22, but that was a pretty cool, moment for me. So I enjoyed writing up these stocks and, and anyway, I was doing everything I can. And so kind of at some point, I realized, and, with the help of some, I guess, like you can call like a mentor and other people who I look up to for guidance, kind of confirmed to me that, look, like you should try to work for somebody who has, a really good track record, has a lot of knowledge to impart. And the way you do that is, you have to keep learning on your own, reading, I was reading incessantly in whatever free time I had. And, Buffett, Greenblatt, Lynch, Klarman, all of that good stuff. And, thinking like, and then eventually if you sit across the table from these people, like they need to see that you're committed, that you want this, that, and that they should hire you. Right. And so kind of, this is like maybe like almost a year in, I sat down at my desk at work and, I one night it was like 9:00 p.m. and it was pretty much done. And I went on Google and I Googled like list of hedge funds or list of value funds in New York, and Octa Finance or one of those really, kind of vague general websites, like they had this Excel sheet and it just had like 2 columns. One column was a list of 9,000 funds, like a database in the United States. And the second column just gave the state they were in. And I thought, okay, well, I only have one screening criteria to work with. I'm going to stay in New York, I suppose. Right. So that narrowed it down to like about 900 or 1,000. And then I spent the next 3 weeks and, whatever free time I had, I literally went one by one, in those 1,000, funds. I caught Control C, Control V. And then I like make notes, like what kind of fund is it? When I want to work for them and who are they? Is it a credit fund like Nix? Is it an FX fund like Nix? This and that. So I kind of like, I whittled it down and I came to a list of like fewer than 10 managers. And, and caveat, there were so many managers, I'm sure, who didn't make it to that list, who would have been terrific to work for. So this is like, by all means, not like an all-inclusive list of like, these are the only people, but, one of them was Bob Robotti and Robotti and Company. And I was looking at the website. He was very public, thankfully. So he had a lot of videos, a lot of like content. And I read literally everything out there on him. There's like at least 20, 30 pieces of content between articles and videos. And I thought like, I really want to work for this guy. He has a terrific track record, and I'm sure it's, it's out there, and I was able to find it back then, like really good track record and kind of, an authority in the classic value investing industry. And so I sent him a cold email, and I sent a few other funds cold emails, met with them. And yeah, Bob and one other fund, they gave me offers. And then, I accepted with Bob. And, the only caveat kind of being, I agreed. It was my idea. I told him, look, I'll work for free. And the offer was kind of like, yeah, we'll hire you, but you'll work for free, right? And like legally, as close to legally possible as working for free can be. And so, look, like how many people in my shoes would do that? Leaving like a great job out of college, working at Citi, and we're a bulge bracket firm, and with all the other exit opportunities that you could possibly get, like go work for almost nothing. Like, again, it was my idea, and I was happy to do it. Right, it seemed like a terrific opportunity, to learn from Bob and to really pursue this long-term dream. So, and it didn't come without its sacrifices. I had to go move home with my parents for a year. Like I couldn't afford to live in the city. I don't have like a trust fund or rich parents to fall back on. And so, but believe me, that was the best decision like I've ever made career-wise, 100%. Going over there, learning Bob is a terrific record, and there's other fund managers who operate in that ecosystem, and out of respect for their privacy too, but they have some of the best records nobody's ever heard of, so to speak, and they traffic in micro caps, small caps as well, and just overall an unbelievable environment, terrific learning experience. I was in a pretty unique role, being I was in their broker dealer arm, right, where like it was a very kind of like open company where like I would still get tons of exposure to meetings with Bob himself and projects with him and with other people, collaborate with everybody on on the asset management side, and then on the broker dealer side, like I was able to do tons of meetings, phone calls, meetings, like in New York, all over the country. We did a lot of trips like with other fund managers, so I did get a lot of exposure to like many different styles of investing and many different fund managers. So kind of 2 years of like drinking from a fire hose. It was terrific. I guess at the same time I was still reading Buffett, and I was still very interested as well, learning more about at Robati and Company. They're very good at, and they have a terrific record on looking at statistically cheap companies like traditional value, right? And, I was learning that. At the same time, I also was interested in learning in higher quality companies, that aren't trading at low valuation multiples today per se, but like long-term, you're taking a long-term outlook on them, and they can truly be these durable, compounders that you can invest in for many years. So, another great thing, I reached out to that same professor who introduced me to investing, and I asked if I could audit his course at business school. He said yes. So, here I was, like Friday nights, Saturday mornings, I was, commuting to Columbia, and I was like taking classes, 23 years old. And that was, a career changing experience as well. And I think that really was very influential on me as well too. So incredibly kind of him. And so kind of the next step after that, after 2 years at Robati, I did decide that I wanted to, kind of pursue maybe learning from a manager who was more, aligned with, has a great record again, looking at these high quality, durable, long-term outlook businesses. And so, I did a company trip, and they mentioned some investor that they really respect, and I Googled him, I've had an interview. And anyway, I ended up, emailing this guy named Jon Cukierwar at Phoenician Capital. And he invited me in to speak, did a case study, and he offered for me to work there. And, and it was a terrific opportunity. So I worked there, and that's where I spent, the last 3 years working before here. And, great people. I had a great, learned so much working there as well. It was a much smaller team, right? It was an investment team of, including myself, 3 people. And so, you really have to be exposed to the entire, investment process, like everything from like the beginnings of primary research all the way to like investment decisions. And, and like he has a terrific record too. There's some articles out there on Google, publicly available, like, 2016, 17, the return between 30 and 40%. Last year, they returned 51%. I was there, net of fees, and, he has built something terrific over there. And yeah, that was probably, my biggest stride of like learning as far as like being an investor, and enough to give me the confidence that, I think I'm ready enough to, to do this, and, where I am today. So yeah, that's kind of, that's kind of how I got here. Pursuing this long-standing dream has been, coming to fruition. At the same time, I really am obviously confident that I have a process in place, and, I've identified a strategy that, can do well, for myself and obviously for my LPs too. So, here I am, and I'm it's really thrilling.
Jon Cukierwar, ladies and gentlemen, there's so many different rabbit holes I want to go down, with everything that you just said. But maybe we'll come back to them a little bit later, because you set me up for a perfect segue into your investment process. So, you sent me over the investment pitch deck, and in there you document how you have this 21-point investment framework. So can you tell me a little bit about that and the investment process that you now employ after all the experience that you've gone to get you to this point where you're now launching Sohra Peak?
Yeah, 100%, Bobby. So, the 21 kind of point investment framework, something I definitely, Phil Fisher has like his 15 points, and, and other very smart investors that I look up to, they have, their 16 points, their, 20 points. So it's not a new concept.
So it's like you have to be above 10 to make it like a real point system. Is that like the thing?
No, it's like, like
has to be above
LeBron
12.
is number 23, so Kobe has to be number 24, right?
Right.
Jersey number. So I had to add an extra point or two.
Fair enough. That makes sense.
Yeah,
there you go. Okay.
Yeah. And it really is, it really is kind of what it is just what I found over my experience, right? Of what's important to me. Like, Phil Fisher has his 15 points. Obviously, like I don't have too much in common with those 15 points, right? I call it points, but it's 21 broad areas where everybody's different. Like, the other week I was reminded of a Bruce Lee quote, where he says, study the greats, study the masters, sift through what you don't find important, keep what you find valuable, and the end result is something that's uniquely your own, right? So there's 21 points are what are uniquely my own. And yes, like it's not a checklist, but more a framework for whenever I view an investment, I want to make sure that, I understand the questions and the answers to, all these things that are important to just about every investment out there. So that's what it is. So I think, kind of can segment into two camps from here, right? There's the investment process, and that's kind of what that framework, attacks. And then there's, the, kind of the strategy or the approach, right? The approach, that I apply like this process to. So, I think, in the interest of microcaps, I think let's start actually with the approach first, because I think, that's what will resonate probably with you and with most is, so kind of like I bucket it into three core areas where I think my approach is very different than the average, fund manager out there, and then from most people. And taken as a whole, I think it is pretty unique in and of itself. Like not many managers or approaches I've seen that really combine all three elements. The first is, looking at small and micro cap companies because they are structurally inefficient. You know this better than anybody. You are the king of the microcap space, Bobby. So, I don't need to explain.
I'm a jester of the microcap space. Come on now. Let's be real now.
So, then I don't know what that makes me. Oh my gosh. So just like a few facts that people are familiar, like the average large cap company out there has 26.1 sell side analysts covering them. Who, people for a living, they have to look at these companies and they have to, try to sift through everything and write an 80-page initiation report, and everything important. And then you also have, thousands and thousands of other analysts, on the buy side looking at it too. Versus small microcap companies, we know plenty that have zero coverage, maybe one analyst, one kind of third or fourth rate shop that covers them, basically nothing. And, and so just the odds and the probability of there being information out there that is not yet uncovered and that does matter to the stock price and that would make it more efficient, like the probabilities are heavily in your favor versus looking at this large cap company, right? And then also, and so why does the inefficiency exist is also because these large fund managers in the United States and globally, they can't invest in these companies for structural reasons, right? Like I was looking at numbers the other day, of the top 500 asset managers in the United States, the average, and this is back in 2017, so the numbers are higher now. The average manager is $44 billion and they have 47% exposure to equity. So that's the end result is like $20 billion that they're allocated to equities, right? And so, they can't afford to invest. They just structurally can't invest in a microcap company, right? If you take, a company that has a $500 million market cap, and, and you look at their liquidity, maybe the ADV, maybe like $100,000 or, to maybe even up to $1 million. And, for any of these large funds to take any meaningful position size and within any meaningful liquidity, days of liquidity threshold that they have, they can't do it. And so, and also, since there's no sell side coverage, a lot of these big funds and hedge funds, they do rely on sell side coverage and research. And, and in the age of data, you have your, all this money that you're spending on third party outlets to kind of try to get an edge this and that doesn't really exist for a lot of these companies either. So they stay away. And so, the end result, of course, is you can have these companies that are inefficient, and statistically speaking, historically, like you look at the numbers, I put it in my first letter, microcaps and small caps do outperform like the larger cap companies. And then eventually the tailwind, right, is that some of these companies that are growing, the microcaps that are growing, and, for the right reasons and with surplus return on invested capital, like they do end up eventually becoming big enough to attract the liquidity and the attention of, the larger funds. And then, then the thing becomes more efficiently priced, and, maybe you get multiple expansion. Not that that's the goal here, it's always fundamentally price and value, but, it can help, discovery of value. So that's kind of the first bucket we all know very well. Second bucket is looking globally, right? And, I think this is something that isn't too common. Most of, the statistics show most of the institutional money in the United States is invested within the United States borders. And from retail investors, it's even higher, something like 90% of retail investors keep within the borders. And, people are familiar with the United States, and people kind of get maybe a little bit scared or wary of international countries. But look, when this kind of started for me, not out of any desire to be different or do something unusual, it was just, I was tasked to screen for companies from scratch with a global mandate. And, I was finding that there's a lot of these companies with very high quality characteristics, right? Like such as those that trade in the US. And just about every exchange in every country without fail that you look at has at least some of these companies, if not many companies, like an average mix of companies that are very high quality, very high returns on capital. You do some research and you find there is some definable moat that exists in the business. And, all else equal, fundamental characteristics equal, they're trading at, significantly lower multiples, right? Like the same company in the US that's trading at, say, 40 times trailing earnings or trailing free cash flow, in another country, like let's say Poland or Australia, might be trading at 25 times earnings or free cash flow, right? And so, so I found this and I kind of, I had to see it and believe it. And, for a lot of reasons, then I said, wow, well, I really think to some extent there is like also market inefficiency here. People are not, branching out to other parts of the world as much. The small and micro caps are even less discovered in those parts of the world, holding everything constant. So here's yet another bucket of inefficiency where you can look and as an added layer, does it add some protection against sell-offs happening in the United States as well? Like, sure. So, like when you look at the cyclically adjusted PE ratios for all the countries across the globe, the US is about 39 times right now. And that's the highest in the entire world of any market, and then along the spectrum, you have most are in the 20s and like some in the teens. Right. And so, you just get cheaper valuations for, and again, like not every company is going to be great. You have to find the good ones and distinguish between, the winners from the losers. Right. So that's kind of the second, element. Taking a global investment universe with, by the way, in developed markets, right? Just about, I'm almost exclusively looking at developed markets, right? You have, higher capital markets integrity, you have confidence in regulations, you have all sorts of structural things that exist just like the United States. And there's no risk of like, civil war happening. There's no risk of like runaway rampant inflation happening. There's no huge geopolitical risk. So, for the most part, they're safe. And, and kind of, like one other, like, for example, talking about like, pushbacks that people give, one of them is, for example, well, how do you know these companies in these markets, like as well as the local investors in a country, right? Like if you're going to be investing in Canada, maybe people in Canada know it better, or, a European country. Like if you're going to be investing in Germany, how do you know, like, as well as the German investors? Well, my answer is kind of framework. I think framework really trumps any, like local knowledge that people have. Like to give an example, Warren Buffett talked about, back in the early 2000s, he had a handbook of Korean public companies, right? Somebody gave it to him, I think from Citi, and he flipped through it. There was like hundreds of pages, hundreds of companies. And at the time there was very poor macroeconomic outlook in Korea. Stocks had gotten crushed. The market was down a lot. And like he went through all these companies and he found a handful, like these, blue chip, really high quality companies that are trading like 2 to 3 times earnings. Like some of them were trading, according to him, really low multiples. And he thought like, well, I'm going to buy a basket of these. And, and my framework tells me that, these are, durable companies that are going to survive for the very long term, and they're temporarily cheap because of reasons that matter to the short term, but probably are not going to hold in the long term. I'm going to buy these, and he bought it. He made a killing, and and the lesson being like, well, does Warren Buffett understand Korean culture better than all the fund managers in Korea and the people that? No, heck no. Like he's Mr. McDonald's and Mr. Coca-Cola. Like no way. But did he have a framework that was very different than 99% of the investors there that allowed him to take advantage of the situation? Absolutely. Right. So like similarly, if I'm looking at companies in across the world and, do I understand? And, it is probably the biggest risk, by the way, of like, not understanding if you're going to buy like a consumer product or like something that could like be like a fad versus like a consumer staple, yes, like it does help to be local. It definitely does help to be local. But, as for most of the investment process, like, as far as like an understanding, just having a framework of looking at companies, and understanding what is the market opportunity here, understanding management, their story, how they came to be, and their focus on the company, and understanding what the company's moat is within its own country, and if that's something I can understand as well as anybody, then most of the rest doesn't matter, right? So I think kind of it's like a busted myth. It's something I firmly believe in that way, and kind of so.
I wanted to actually quickly follow up on that because, and look, we'll get back to the 21 points in a second because I have another question on that. But, when you're talking about the global bucket, this is like the classic question that every interviewer would probably ask you, like, what looks interesting right now? I mean, what countries have been kind of standing out in some of your fundamental research?
Yeah, absolutely. Without giving away my whole book, like a few countries, right? Like Canada is.
So I said countries. That's why I said countries, not okay. All right, continue.
Like for example, like countries, like Canada is a great place to look. I did talk about in do your own due diligence, and this is not investment advice. Like I talked about in a recent podcast. Go easy, and they're listed in Canada, and if all else equal, if it were trading in the United States, it probably would be at a higher multiple. Like Eastern Europe, Poland, I've definitely have my eye on a couple of companies there. Australia, have my eye on a couple of companies there. Like for example, like one, I'll give like a vague description. Like in Australia, a company I'm probably I might be writing about soon in my next letter. I've found, and and it's it is a microcap company, and they have a founder who founded the company back in 2005, and he still owns 56% of the business. He's on the board, and he built this thing organically from like a tiny from scratch private company in 2005, and just about they're in a cyclical industry, but they have a niche in the industry that prevents it from being exposed to cyclical forces, and I think it's slightly misunderstood for that reason. But he's built this company organically, right, from $0 in revenue to now they're doing some in the order of $300-400 million of revenue, and they are dominating a clear niche over there where they are 10 times the size of their biggest competitor. So they don't really have any competition, and their biggest competitor isn't really attempting to grow. They built something very special with their culture. Their value proposition to the clients makes complete sense, and their clients love them, and they continue every year to just expanding their business. And now this year they're expanding internationally. They're having a lot of early success in the new geographies that they're expanding to. And they can increase the size of their business long term, or they can increase their profits by by my estimate like 7 times what they are today. And it's just been their track record of growing this business in the right way and expanding margins has just been like a rocket ship. Like I think their CAGR over the last 5 years has probably been I think like 40 to 60%, something in that neighborhood. And COVID slowed it down a bit, but it also provided arguably a buying opportunity. So anyway, it's done well, and but again, it was just an example of like something that I found organically, and they were trading at a very depressed multiple. I think 9 times, trailing earnings, free cash flow. They're it seems it's a high chance that they're going to continue growing at double-digit high clips of revenue and profits. They have all these terrific high quality characteristics that I look for in a business, and management is skin of the game. There's been tons of insider buying recently, and they just, because they're so small and they're so illiquid, they have no coverage. They're covered by one sell side firm that you've never heard of, and so.
Why do you think so? We were talking about this offline, how, microcaps, there's been just so much interest, since 2020. Why do you think that global opportunities are still getting overlooked? Is it because the new interest is like, look, we need to just wrap our hands around what's going on in the US first before now you're telling me Canada, Australia, Israel,
right.
Whatever. We're just trying to, is that really, in your opinion, is that what you think is happening?
I think on average, right? Retail investors for sure have home bias. Everybody has a home bias. There's studies that statistically show you have a home bias to your own country. As far as these, how hard is it? How often do US microcaps get really found? Better than anybody, because you look at them for a living, and I'm sure you still find excellent US microcap companies that are undiscovered or hidden gems, and the Expels of the world that have become more publicized and have been 100 baggers, and they eventually work out. Once upon a time, it started as a $10, $20 million company that nobody ever heard of, right?
That, not just a US based, but US based with a Canadian listing. Yeah.
There we go.
Full disclosure, I'm not a shareholder. John, are we shareholder in Expel?
No,
okay.
Sir.
All right. So no, you're right. There is a home bias, and it's actually kind of funny when you brought up Canada. Just a little plug. That's our next virtual event that we're hosting in December
I've seen that. Yes.
With Small Cap Discoveries is our lead sponsor. But besides the point, I do want to go back though to 21-point investment framework. Without going through all 21 of the points, and that's your proprietary stuff, right? You want to wait till somebody's considering to be an LP, but give a flavor. What's a couple things as part of that framework that you say really differentiates you, maybe from some other funds that are in a similar AUM?
Absolutely. So, as an investor I really look up to, Girish Baku of 10 Core Partners, as he puts it, this is long-term, high conviction investing. Right. And then, except he's investing in large and mega cap companies. He's unbelievably brilliant, and it's a much tougher game, but I'm taking that to small micro cap companies. Right. And so I can bucket it in four. From 21 points, I can bucket it in 4 areas of the process that, definitely, happy to talk about. And so, and really, the premise of all this is long-term investing, right? Which is another, differentiator. But, if you're trying to, for example, if I were trying to invest, my assets in companies with a next quarter time horizon, doesn't matter all that much or nearly as much what the quality of the business is. Probably not, right? You're looking at an earnings beat, or a special situation at hand, right? Trying to understand something going on, in the business that, that's misunderstood, by. And it's not the consensus view. But if you're really looking long term, right, that's another source of arbitrage here. In addition to small caps and global, you're looking at long term as a source of arbitrage. The average holding period is now 5.5 months for New York Stock Exchange stocks, according to a report that came out this past summer. So look, the process is, I'm really looking at, obviously you have to screen for your companies, and, I guess starting here, in the beginning, screening the companies, I really enjoy this part of the process. I have my 14,000 companies, which, having a global universe expands my universe by about a factor of 5x. If you're US only, it's about 2,800 companies within most reasonable parameters, between micro to mid cap. 14,000, and, I have maybe call it 20 different metrics or data points, on an Excel spreadsheet, that I lay out, right? I pull in this data from, a provider, call it Capital IQ, and, and I have that all in front of me. And, I guess a lot of people too, when they screen for companies, some people, they use the providers directly, or, they kind of, they take an A to Z approach, which if you do look at every company, that's the best thing you could possibly do. Can you give it the proper time and attention? That's going to require a lot of resources. And for me, I have my metrics, and, I don't have to just sort it by one. I can do a combination of, meet some minimum threshold here, minimum threshold here. it is, it's ranked, accordingly here for this metric. And so kind of, take a combined approach and, look at, maybe 1,000 out of the 14,000 that most interest me, almost, the rest are almost eliminated or not prioritized, I should say, because of, they don't meet certain criteria. And so, once they get there, right, the beginning of the process is kind of, you do your basic primary research, right? You do enough research to think, are you interested? And obviously, reading through, their latest annual report or 10K, reading through their investor presentation, Googling, looking up articles, kind of trying to learn more about the space they're in if you're not very familiar. Most times they're, you're not totally familiar with the space. And so, then conducting, phone calls with the company and, looking at third party, any third party, documents that exist, like expert network calls, like transcripts. There's a lot of good resources now, Tegus, Third Bridge, and you have friends who who have the transcripts and things like that. And so primary research is certainly part of it. Really, what I'm trying to figure out though, right, is if I'm taking a long-term approach, most of this framework is to determine, is this company trading for a price today that's significantly below its intrinsic value, and intrinsic value judged by its long-term future free cash flows. So everything comes down to that, and everything in the framework you're trying to to solve for value, solve for V. And so when you're looking at the next couple of years, right, the consensus is usually not that far off. And and that's where Wall Street looks 1 year ahead. A lot of sell side, you can look 2 years ahead maybe, but once you go beyond 3 to 5 to even like 7 years, it's very hard to determine what a company in an industry is going to look like in 7 years. But that's where the money is made. That's where the big decisions are made. And so what I'm really looking for falls under kind of two categories, right? Business quality and then management quality. So really looking at talking about business quality, right? Like if you're looking at a company and you're trying to figure out in 3 to 5 years, like what are they going to earn? What are their profits going to be? They probably, if those profits are going to be, growing, and those profits are going to be, compounding over time, the company probably is going to need to be doing something special in their space, unless the space is growing, the TAM is growing by an exorbitant amount. But then again, if a company is in a fast growing space, but they're doing nothing different, they're not going to earn any excess profits, of course. So, something special they're doing, a competitive advantage, very widely used word, of course, but, competitive advantage that exists in the company. Oftentimes if the company's profitable already and you look at their return on invested capital, right? Like, and if they're earning, something like far in excess of their cost of capital, like, they probably are doing something very special. If for like the past 5 years, the return on invested capital is like 20 to 30%, statistically, they're probably doing something special, and you need to find out what that is. And then, of course, that's just a starting point, but like, that's, what that is. Or, oftentimes they're not profitable yet, like some other companies, but they are doing something special. And one day, eventually, like they will be earning a very high ROIC. So, so if, so a lot of the framework is questions, kind of surrounding, like what are the unit economics of the business, right? Like exactly like, if they have a standardized product or service or a few, like, what exactly, breaking it down in very granular detail, right? Like, what is the product, what is this? And what are your customer acquisition costs? What are the lifetime value of this product? And, how quickly are you going to grow this? Like, why are they going to be this? Why are they going to be sustainable? Looking at their operating expenses and, figuring out, asking like, exactly what is this? What is it going to be? And trying to dissect everything, understanding the business very, very granularly, and looking at, traditional things, barriers to entry, barriers to success. Is the business really doing something, truly special, or, is this more of a commodity item that a new entrant can come in and compete away? Track record comes into play here in a big way sometimes. If a company's been doing compounding pre-tax earnings per share, for like at high rates for the past 10 to 15 years, that can really help. Kind of give you a sense. So business quality is very important, and just scratching the surface here, obviously things come into mind, but market win share, like what percent of the new customers in the new market coming online are they winning? Things of that nature, right? Then you have management quality, I think, is the other kind of big bucket here, right? And so management quality, a lot of people they prefer not to, not to kind of put too much weight on management, or it's very difficult. I've come to think, and I don't know, the more experience I get, I only think it's more and more important, any competitive advantages in the business, any way that the business is kind of designed, right? It's every day the CEO is making a decision that either is making the company better or making the company worse. They're either building economic value or destroying it. And, the CEO and the managers around him, who buy into the culture and the vision, and then everybody at the company, right? And what they're trying to build towards and around. And so, I guess if to bucket it kind of in four groups, looking at the managers and looking at their skill, which the best thing, in my opinion, the best thing you can see for the best proxy for skill is track record, right? Of the company. Like if you're looking at a company where they're brand new or the CEO is new and they don't really have a record at a similar company or the current company, or even sometimes it could be difficult. Like if it's a replacement, somebody who's worked up the ranks. If the company has a great culture, then it could be easier to think, okay, well, the CEO is going to pick up where the old one left off. But if there's a CEO who's been there and they've been compounding earnings per share or free cash flow per share for like 15 years, right? You probably have a good sense that they know what they're doing. They are probably going to continue executing here. If everything else is in place, right? Industries can change very quickly, but like compared to a new CEO, this CEO is probably going to continue doing what it is they're doing, and it'll help you give some confidence. Skin in the game is very important. And if they don't have skin in the game, if they're a newer CEO and and maybe they have an incentive plan where they're aligned with shareholders, is very important, right? Because you can have a business where they're optimizing for the business. It's a terrific business, but the link from business value to shareholder value is not that great, right? If the CEO doesn't own any stock, and the CEO is not a founder or not an early employee of the business, then maybe how do you know that when as the company grows, they're going to be incentivized to maximize per share value rather than something else in the business, right? A lot of them are maybe corporate CEOs. Maybe they're ambitious for themselves. Maybe this is just like a 3-4 year job on the resume before they go do something else, or maybe they're interested in cutting some other deal, or maybe they're interested in I don't know, one of those things, maximizing for whatever their bonus is. If the bonus is not aligned with shareholder value, maybe it's improving operating margins, or just revenue growth, stuff that isn't necessarily correlated with shareholder growth, right? Ambition and vision is very important too. Like if you have a CEO, it makes a world of difference, right? Between somebody who is, when you ask them, like, where do you want to be in 5 or 10 years? And what are your priorities to getting there? They don't necessarily, have a compelling reason, like, oh, well, we're, in the next few years, we want to continue doing this. And then, we're looking to innovate new products. And then we're doing everything we can to grow the top line. And then, and they don't really, it's kind of clear they don't really think like very long term. But, if you talk to somebody and they just look at you and they tell you, well, it's been the same thing. We want to be the best in the world. We want to be the number one in what we do. And here's why. And they lay out a crystal clear vision of their priorities. And you can tell that they think about this a ton. And they can articulate it well. Like that makes a world of difference, because if you want to invest for the long term, you need the right CEO, but you also need them to be there and to be on the same team as you. You need them working for you as hard as possible, while you sleep at night, right? So those are some things that are important, for instance. And I think a note on integrity is important too. Obviously, and integrity is interesting, right? Because everybody, like, for example, when I was taking the CFA, like, levels like 1 and 2, there's the ethics portion. I think all 3, there's the ethics portion. And, a lot of people like kind of fail the ethics portion, or they don't do well, and it hurts their score because they're like, oh, well, I'm an ethical guy, or I'm an ethical girl. Like, I'm going to nail this. I know what's bad. I know what you shouldn't be doing. Right. But I think the same thing goes with like integrity. Like you think, oh, well, like obviously if the company's like, if it's a fraud, or if the CEO went to jail, or he's a felon, like I'm just going to stay away. But like integrity I think it's a lot more subtle than that in the ways that it matters, and the ways that you can actually see warning signs before investing, right? Like I'll give you an example, like, like one, like, not naming a specific company, but, there was one CEO of a company, that kind of really collapsed a couple of years ago that I knew quite well. And he, he'd run 2 successful companies before that, and including that one, and they had good runs and they had good track records. But he did have a history of doing some things that were maybe not necessarily, kosher, but we're okay. There was good reasons behind it. And so, nobody really, faulted him. But, kind of when the whole company collapsed, the reason, one of the chief reasons behind it was because he was being dishonest, I would say, about how the company was growing its capital base, we'll call it, right? And he was communicating for years and years where it's growing at this percent for this reason from these constituents. But at the end of the day, it was growing that fast, partially for the reason he was saying, but partially for another very, very risky reason that ended up blowing up. And then I remember seeing him, like, while this was going on, and I kind of like discovered all this. Like, I went to another investor presentation that he was giving. Like, so the company still like had at least another like half of a leg down to go, but like, he was giving his PowerPoint pitch for the same company. And he was, again, just saying, oh, we're growing this fast because of like these core reasons. And he wasn't telling the other side of the story. And I kind of think of that as like, it's like a subtle breach of integrity, right? He's not lying to your face, but like, he's not telling the whole truth at the same time. I know other companies, examples like, if they put out like a target EBITDA margin, right, of like, say like 15%. And then you get on the phone with them and oh, well, how exactly are you going to get to 15%? And they can't really get you there. And then they kind of mention, oh, well, so, and they'll give you some reasons that it's not an exact path to get there, that it's not clear that they know how they're going to get there. They say, and that's why we think we're going to get to 10%. You say, well, hold on a minute. You think like, well, you didn't give a clear reason. And, and what is the real number here? Little things like that, at least to me, I kind of view them as subtle breaches of integrity. And, and maybe, it's obvious the incentives that exist for them. Like they want to put out, or if they suddenly expand their TAM, like, they either want to, they want people to think they have high TAMs and higher margins and higher forecasts so that, they're going to raise the stock price, right? That's always the reason. So, anyway, just, I think, just an interesting aside there. But, I think that kind of wraps. And then, lastly, just, very big addressable markets. It's almost its entire category entirely because, you have these let's say you have a company with a very high quality management, very high quality business, for the specific reasons of the competitive set it's in. And then, that's great. But if it's operating in a very tiny addressable market, it's not going to grow, that quickly. Like it'll be the best at what it does, but the niche is going to be so small, you're not going to get kind of like, huge eye-popping returns here. The potential is just not going to be that great. I mean, that alone would still be a very solid investment, a safe investment, but depending on the valuation, but like, so having a very long, wide runway to kind of compound intrinsic value is paramount. And then lastly, tying it all, price and value. Like you could have a company that fits all the 21 points of the framework. Something that's terrific, best company in the world. And I'm sure you can think of some right now. But like if it's trading at a really, really high multiple where you're not going to get a meaningful yield on your purchase price, as far as free cash flow for like many, many years, like, 5 to 10 years. And then finally from there, you can start compounding and like, it could just be very dicey and there's a lot of downside risk, I think. So, price and value, everything comes back to value at the end of the day as well, is my firm belief, right?
100%, right? I mean, despite whether you have as detailed a framework as you have, or you subscribe to the 2-point system or whatever, at the end of the day, if you're not getting your price, hey, then
right,
it's probably not something you're going to look at. But
yeah, and on the converse, you want to find something like so obvious, right? Where the price and value disparity is so obvious, you don't even need to precisely calculate, value. You don't need a spreadsheet to tell you it's going to be, 6% yield this year, 8% yield that year, this per share that. You just want something so obvious that, however you measure value in a fundamental, way in using the correct math, that almost no matter what happens, or even if the price is a bit up or down, you should make, a high return on your investment. So that's my closing thought there.
No, for sure. All right. So I want to get my one last question on, your investing framework and everything. And this, yeah. And you've talked about a few examples, not naming the companies, but in your investment deck, you did give a couple case studies. And, this is actually one of the companies you mentioned on there is one that I've done a number of interviews with over the years. In fact, I featured them on the MicroCap graduation series here on Planet MicroCap, the company EXP. So would love to hear, and relatively briefly, what your thesis and how EXP demonstrates, this investment framework that you just laid out for us.
Yeah, absolutely. Yeah. So EXP that company they've had a good run. They've done very well, especially last year. And, that's a company that I'd seen them present at a lot of these small microcap conferences back in 2016, 17, a long ways ago, and then really became interested in the company, in later 2018. It was, I think it was trading around like $7-8 a share, pre-split even. And so, yeah, I mean, there was a few attractive things about it, right? Number one, straight off the bat, like they were growing at like 100% a year. They were growing monumentally quick. Two, they had a founder CEO named Glenn Sanford, and he had built the company in the 2000s, I think late after the financial crisis, around 2008, 2009, if I recall correctly. And so right off the bat, those two things, okay, like they're growing very quickly, and then you're learning about the business model. And three, he was doing something very different, where he had so a little background. EXP is it's a virtual real estate brokerage, right? Today, the word virtual and online is everywhere, and every company's virtual. But even 3 years ago, like it was still a foreign concept in most industries. Meaning, they are real estate brokerage, and they've never had a branch, never had a single branch or an office. And their competitors have like hundreds, maybe like thousands of branches, like across the United States and other countries. So what was interesting there too is, they were growing very quickly. They had no branches. So this company is interesting. That alone right now is really interesting. Like, I want to learn more about this. Like, they were losing money. They were growing really fast. So, so you talk to the guy and you hear interviews on him, and, but you talk to him, and, and they're explaining the business model. And so, kind of the really interesting things about EXP were, the core reason why it was growing so fast was because, a couple of reasons. One, they didn't have any branches, and that freed up so much money in operating costs that competitors like, Realogy or sorry, I'm blanking right now, but some of their competitors, Remax, sorry, then you have Sotheby's, you have Coldwell Banker, you have all these different brands in the real estate space. They have branches and offices, and that's a huge expense freed up. So they were free to like allocate that money elsewhere in the process. So they allocated it in two ways. The first was they gave their agents a better deal. So the agents got to keep 80% of their split. They kept 20%. And, at the time, like a lot of the office-based ones, like, even as recently as a few years ago, were offering 60 to 70% split. They're offering 80, and it's only getting more competitive now. But, the other really interesting, unique thing was they had a kind of a multi-level marketing structure, right? Multi-level marketing, it's a bad rap, but, in certain ways, there's definitely big differences between like, a bad multi-level marketer and a fine one, a good one, right? The bad ones are where, end consumers get stuck and pay up front with a ton of product that they can't end up moving. That's pretty predatory, in my opinion. But here it's, it was multi-level in the sense that agents could make a lot of money. They had opportunities to make money. Like, if they referred another agent to the platform, to EXP, and then that agent completes a home transaction, then the agent who referred them makes a small percentage of the commission, right? And then it goes down 7 levels. So he structured it. He took the idea from Keller Williams. He structured it such that, like if you refer this agent, and then this agent refers another agent, and this agent refers 10 other agents, and those 10 agents refer 100 agents, you make money off of like every single one of the people in that pyramid. And so that was a big reason why the growth was exploding, because they were getting a pretty good deal over there. It was good, right? Two, also, one great thing he did, which ended up, I think really helping the stock skyrocket, was he made sure that like almost every agent had the opportunity to own shares, and most of them took advantage of it. Where like, if you complete your first transaction, like you get some shares in the business. If, you can opt to, buy like, up to like 5%, I think of your annual commissions and get paid in shares instead, things like that. And so a lot of these ended up being shareholders, and they ended up, referring people to the business. Like they had like an analyst day back in 2019. And, it's funny. This is really funny. It was a shareholder meeting, and, go in and we expect, there's going to be like 10 people here. It's a small microcap company. Who knows about it? There's like 1,000 people in the auditorium because it's all the agents, they're shareholders. And they all showed up and they love this, they love the founder, and there's a huge kind of a cult-like following within the company. And, there was at the time at least. And I'm sure there still is. And so, the end result was, the company, and the biggest knock obviously was that they weren't profitable. And also I think a very irrelevant, but big item that got picked up on short reports was that, like, the way that the agents communicated, not in person, was this virtual world called Verbella. And it's like, imagine, like, did you play The Sims on your computer, like growing up? Like,
oh yeah.
Then I guess maybe like cross between like Sims and like, Nintendo 64 graphics kind of, but it's like you have your avatar and you walk around the world, and it's like, it's 2021 and they're still like, it's like they're playing Nintendo 64. It's it's kind of funny from that perspective. But some people are like, oh, look at this, like it's a company with these horrible graphics, whatever. But like it worked. It was a working solution, right? And it still is. And so the end result that happened was, as they were growing, they had a clear path, through discussions where they had a clear path where like they could get to profits. And, eventually over the longer term period, like, this is a longer term holding that, and to clarify, like if you're looking at the situation, the investment thesis was predicated on long-term success in my view, was that, right now they were like had a negative, single digit margin, but long term they should have a much, much higher positive margin for this reason, and this reason, right? Once they hit scale. And that's what happened. It was definitely accelerated during COVID because in 2020, they, home buying obviously has had, quite a run. Everybody's moving away from the cities, and they're moving to more suburban areas. They're working wherever they want to. And so, home transactions reach like all-time highs by, for the company, by like major levels. And, prices of homes were increasing too. So that was a double whammy on the upside. And then because all these shareholders, and this is something that I haven't like confirmed, I never like asked them about, or it was just my own thought, because like the majority of the agents are shareholders. And think about it, there's some of like real estate agents are some of the most skilled on average salespeople like in the world, right? Somebody who's like a really good, like, like real estate person, like they're also like, they sell all the time. So they own the stock. The stock is like going up because real estate's booming. And then, and then like they're incentivized to recruit people still to the program. And then they're probably pitching the stock to like all their friends and people they know, because the stock's going up. It goes from like 7 to 15. And then it went from like 15 to 20 to 30 to 40, 50. All of a sudden, this thing went from, $70 a share to I think it's absolute euphoria. It was at $150 a share, right? And then they had a stock split, and I think it's kind of calmed down now, but it's certainly been a good performer. But anyway, I mean, look, at the end of the day, like, for the fundamental reasons, like, it was growing quickly. They were doing something different. They had the competitive advantage of being the lowest cost operator in the business. They don't even have a headquarters. How can you compete, on the cost basis with a company that doesn't even have a headquarters? It's the CEO's house in Washington, by the way. Him and his ex-wife together own like 60% of the business. And I think he's a billionaire now. And, but look, he, from humble beginnings too, like he built this the right way, all organically, right? Like he gave stories like he started this business without branches out of necessity because he couldn't afford them. He couldn't afford to start a brokerage firm with branches. So and then he figured out it worked. He used to ride buses like around the country, like giving pitches and seminars to why real estate agents should leave and their team should join EXP. So the stock is, I don't know, maybe up 1,000x from like the very, very, early days, maybe more. It's really incredible.
Yeah. I remember, I think I remember in the graduation series, he said like the main like inflection point was like, there was one real estate broker that like he knows if he got him to come on board, then that was it. Like he knew that he would get like a majority of them. So yeah, no, that was, I remember talking.
Was that Eugene Frederick?
I don't remember exactly.
Okay.
Name, but I don't even think he said the name. Maybe maybe he said it on. I can't remember. But like, who knows? It might have been him. But yeah it was like that. That was like that one transformational hire that like completely changed the game.
But also, company. By the way, like we see this all the time too. Like reasons why companies sell off for the wrong reasons. They had an accounting restatement in like 16 or 17, and the stock it sold off quite a bit. But really, when you're looking, it's arguably a weakness with the company, but they, it's not like they had it. I think it's pretty clear. One, the restatements were very minimal. Two, like it was clear nothing nefarious was happening. Just some things were booked incorrectly, right? Some things were booked as like, as cost of sales instead of contra revenues, like something very minor like that, if I recall correctly. And anyway, the stock sold off. So then like, there was a lot of kind of, I think misunderstood reasons at the time why it was trading very cheaply. But that's very cool. I'm glad of course, the name, you're the king of the microcap space. So
stop. Well, and for full disclosure, I'm not a shareholder in EXP. John, are we still a shareholder in EXP?
No, well, I'm not a shareholder in EXP. No.
Gotcha. All right. So we're rounding the corner here in our interview today. So, my favorite question to ask everybody is, what would you say is an investing experience that really changed your career the most? That one thing that you're like, wow, this is it.
Investing experience that changed my career the most. I mean, I think the two biggest steps for me were kind of, I think when I really joined, when Bob Rabati was kind enough to offer me to work for him. I mean, that really changed, like, career-wise, the most, and having the opportunity to learn there, and kind of being extremely fortunate to be exposed to, like, my first exposure in the investment world was to, like, these unbelievably kind people, where it was a total idea meritocracy, where if somebody who's 20 years old has, makes a good point that somebody who's 60 years old, thinks is right, they'll give them credit, and there was no egos over there. The other kind thing was, the opportunity to take that, a course at Columbia's executive MBA program by extreme kindness of a professor. And, he was very kind, and that was an unbelievable experience being there. I'm kind of trying to think too of, like, maybe like a funny or, cool, like, one-off experience that really changed me. But I think going back to maybe going back to just, like, being a junior in college, right? And, we're told, okay, well, tomorrow you're going to meet the CEO of Popeye's Louisiana Kitchen. I'm like, okay, well, that's a big deal. I'm barely qualified to probably meet the janitor of Popeye's Louisiana Kitchen, like, but I'm sure I'm happy to meet the CEO too. And then and we were really stoked to go kind of to see if there was a restaurant nearby, which we ended up doing. And they brought us to, like, a local, Popeyes over there. There was, like, a huge line, and like they saw, like, the president of the company was there, and they kind of let us cut the line. Then we got one of everything on the menu, and I was so sick, like, coming back home that night. But I think just really kind of, like, sitting there and seeing all the, the CEO, the CFO, and the president, and just being able to ask questions, like the first true management meeting I ever was a part of. I think that was really remarkable. That really truly was, like, one of those, maybe the most powerful one-off moment that I can remember, where I'm like, this is unbelievable. I'm just floored and captivated by this moment right now. And it really, it was a big deal in advancing, my interest in pursuing this path.
Very cool. All right. So, I usually ask about advice that you would have for new investors, but I'd rather close it out on a question that I wanted to ask earlier, but you were on a roll with your background, and we were getting into everything. So one thing that really resonated with me is, I'm also Jewish. You mentioned that your grandparents, came over here from Poland, survived the Holocaust. I'd love to hear some advice or just some life lessons that you learned from just being around them, being in their presence, being able to ask them questions. Love to hear some of what they had to convey.
Yeah, I really appreciate you asking about that, Bobby. Nothing to do with investing, but it's very personal to me and my family. So they're no longer with us. When they were around, it was very interesting, right? They never spoke about their experiences. I imagine so harrowing that they just never, could bring themselves to talking about it. With my parents, or with my dad or my uncles and aunts, nobody. But it was, I think, kind of takeaways there. The biggest takeaway to me was my grandfather. He lived until 90 years old, and despite, like, everything they'd been through, right? Like, when he was a kid, he had to go work during the time of the war, and they got rounded up into one of the ghettos in Warsaw. And he still had to go work and as a baker at like 12 years old to go provide for his family. And one day he comes back and, things were only escalating, like, every week. He comes back and his parents are gone. His sisters are gone. All of his family is gone. And he never saw them again. And, for him to go through that, and then how he survived, and how, the things I do know that he had to go through, notwithstanding any of that, he was the kindest, most, giving, person you'd ever met in your entire life. He didn't have a single, he was never upset, never angry. He was only, he had only, positive, kind things to do, to say, the way he brought about him. And I was always kind of puzzled growing up. I'm like, Daddy, like, I'm asking my dad, like, how come Grandpa, after everything he went through, like, he's like, how can somebody carry themselves that way? Right. And, my father would say, look, honestly, I wonder the same thing. I mean, if I ever went through something like that, he had every right to be angry at the world. He had every right to be very bitter for the rest of his life, but he chose to instead, be unbelievably kind and have 5 children, to kind of recreate like his family here. And now we have a wonderful, terrific family. And, as far as like me too, it's given me this mindset that I think has really helped me persevere through life. Right. I think about, I think about what they went through and the horrors that they went through, and they found a way to survive, and they found a way to get here. And help, through 2 generations, give me a wonderful life. And, whenever I have something in my life come up that is obviously unbelievably tiny by comparison, and, and I think it's a challenge, a lot of times I come back to this and I think, well, like, what do I have to complain about? If they can make it through, everything they went through, I'm going to find a way, and I'm going to be okay. Like, whatever I think is hard or annoying or difficult or challenging, I'm going to find a way, because it pales in comparison, and I'm going to be great. So, I mean, like, it's been a very profound impact, and, but I'm unbelievably proud of it. And yeah, and it's been, the result has been a wonderful extended family. So we're all here, and we're all great, thanks to them.
Very cool. So I had to ask. I mean, it's stories from folks that have survived the Holocaust. They need to be heard as loud and as wide as possible. So, any chance I can ask, especially from folks that have made it through. And, so thank you. Thank you for sharing.
No, Robert, thank you. That means a lot that you asked. So thank you too.
No, of course, dude. All right. Well, to close this out here today, I mean, again, thank you so much for spending the time and doing the interview with me, and sharing, your entire framework and how you got to where you are. Where can our audience go and find more information about Sora, as well as follow you on social media?
Oh, sure. So anybody interested can visit my website, sohrapeakcapital.com. And I'm on Twitter as well, with the handle Jon Cukierwar, JonCukierwar. And yeah, that's where you can find me.
Very cool. Well, Jon, dude, next time you're out here, you're coming to a Shabbat dinner, and I look forward to meeting. Yeah, I look forward to meeting you in person at some point. And really do appreciate you taking the time today. Thank you.
Me too, and it's wonderful to meet you too, Bobby. And I had a great time on the podcast. Thanks so much. You're the best.
Thanks, bud. Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.